Good day, ladies and gentlemen, and welcome to the show. On this, I was just checking my audio. Anyway, welcome to the show on this Tuesday, July 26, 2022. Thank you for tuning in. Glad to have you guys here. I'm going to tell you, I smell a rat in epic size and proportions. I did shows over the past year or two, and I kind of plotted out what the Fed was going to do ahead of time, and I was pretty damn close to what their plan was. And what I was talking about basically is how the Fed's going to, before they did it, how they're going to raise interest rates, try to quantitative easing and everything else. But what I was saying is, specifically, is that the Fed was going to induce a collapse in the markets. And then I said that they would pivot and turn things around and we'd head toward hyperinflation. That was basically the outline of what I was saying. And I was saying that before anybody else out there was talking about it. And it followed pretty much true to what was happening. But what I didn't see was that this is all part of an orchestrated, I would call it, I don't know really what to call it, some sort of a scam that they're pulling on all of us to manipulate the markets. And I thought they were going to cause a collapse. I don't think that was the plan at any time, was to cause a collapse. I think what they were really trying to do was extend the power of the dollar, carry the dollar forward in its value. And in fact, it's worked. I mean, the dollar was, when they started this, the dollar was what, 86 or something like the DXY, and now it's 107 this morning. The dollars went way the hell up during this period in time. I think it's the biggest head fake in the world that they're pulling on all of us. I don't think they ever intended to collapse the markets now, I'm starting to think. Because of what they're doing on the yield curve right now is why I'm starting to think this. So basically, on the really short end, on the overnight rate, they've been raising rates. But on the long end of the yield curve, we got somebody out there manipulating the long end, specifically the 10-year. I mean, who could that be? Because it takes massive amounts of liquidity to move that, to budget, because it's 10 times bigger than the stock market. Anyway, let's get in there and let's, okay, give me a second here. I'm going to open up the charts. Let's open up the charts right here. Just look at these articles right here. What we're seeing. 10-year Treasury yield extends its slide, falls below 2-year yield. 2 and 10-year Treasury yield fall below 3% as recession fears dominate financial markets. You know, nobody's talking and saying, hey, who's the buyer of all this gook and schlup? Who's buying all that sewage? Well, in my mind, I just think the Fed's the buyer. That's what I'm thinking to myself. And I think they're manipulating the long end of the yield curve, which is called yield curve control. They're controlling the long end, and this has a tremendous effect on markets. If they keep this up, pouring this money in here on the 10-year, and the 10-year keeps falling, I mean, the net effect is that things could start to turn around and change from this bear market that we've been experiencing. Look, the 10-year, look, guys, the 10-year was rising up over 3.25% just a matter of weeks ago. Right? And what did we see happening to the markets out there? We've seen big drops. We've seen the market drop below 30,000. Right now it's still back up above, it's back up. They've stemmed this off by messing with the 10-year yield and messing with the yields on the long end of the curve. And so it just counters everything that they're doing on the short end. They never intended. Yeah, they wanted to fight. Yeah, I believe it's true. They want to fight inflation. They wanted to fight inflation, so on, so-called fight inflation. They wanted to preserve the purchasing power of the dollar a little bit longer, and they've done it. They've pushed it off. This is just another move at kicking the can down the road, but the whole system is structured for inflation. And we see that if we just look at the whole thing going all the way back to when they first instated the Fed and what our dollar was worth. Or what our dollar was worth back then and what it's worth now. It's lost like 98% of its value and it's going sliding fast. Look, if you're a saver, you're guaranteed at least 10% of your purchasing power to be gone, keeping your money in the bank 1 year. And what kind of a rate of what is the bank paying you to hold your money? Little or nothing. You know, I mean, you can't win as a saver. I mean, if you're losing 10% in 10 years, all your money's gone. It's lost all of its value. So at a certain point, you know, inflation starts to become a self-perpetuating, self-feeding cycle. I don't think they ever really intended to actually stop inflation. They just wanted to kick the can down the road a bit longer, and now they've done it. They can't move much further with this, or they are going to. See, they have induced a recession, and they will induce a depression. I don't think they want to go there. It's all right. They induced a recession. They knew they were going to induce a recession, but they were willing to go there in order to keep the dollar going for another 6 months or a year. And they were only willing to do it as provided that they never admit that they did it, which is what they've done. They haven't admitted to it. Hey, we caused a recession. No, they're out there saying, oh, there is no recession. You get their heads in the sand. They're like a bunch of ostriches with their heads in the sand. So, but it's here. But I think this is as far as they're willing to go now at this point. I'm starting to think they're not willing to really, they're not men, they're mice. And they're not willing to let the market drop down to 25 or 26,000. I thought they were. A few months ago I said I think they'll let the market drop down to 25, 26,000 and they'll turn around. My thinking is changing. I think they've had about as much as they're willing to take right now, and they're just going to start to continue to mess with these yields, doing this yield curve control, and it's going to turn things around, and it just completely eliminates what they're doing on the short end with raising the overnight rate. In other words, they're still pumping the money out there, and they're going to continue to pump the money out there. And if anything, they're going to pivot even harder to pumping the money out there. And this whole process is just going to keep right on going. So, I mean, we might be nearing seeing bottoms now in things like cryptocurrencies, gold, silver, you name it. We might be, real estate, everything. We might be approaching. It's very possible. I'm just saying it's very possible right now we might be approaching the bottoms. And so you might get your best buying opportunities before the dollar's worth nothing in the end, because that's where it's going. Ultimately, in the end, we're 10% inflation now. Maybe next year we'll be at 25% inflation, and then it'll speed right up. Once it gets past a certain point, then people say, I'm not saving money anymore. I'm spending it as fast as I get it. That's when it starts to really get out of control, the inflation rate, because it's a self-feeding cycle. So here we go, guys. We're off to the races. Let's take a look at the silver price today. It's up 20 cents at $18.65. And, you know, I mean, you cannot deny the value of gold and silver right now with these prices. I mean, they can barely produce it for these prices. $18.66. It takes like 300 pounds of rocks. That's like a whole wheelbarrow filled right up full of rocks. And they got to crush that down to powder, and then they got to filter it and put it through chemicals and stuff to get 1 ounce of silver. Think what value you're getting. Because it takes diesel fuel to pound. They quite literally pound those rocks to powder. They have a machine, it's called a rock crusher. That's what it's called. They drop the rocks in the rock crusher, and it is actually to crush them into powder. Well, first it crushes them down to smaller rocks. Then they go up a conveyor belt into another rock crusher, which crushes them even smaller and smaller and smaller, until basically they put them in a tank, and then they mix it with other chemicals which separate the silver from the rock. And then they have to go through a burning process of melting that into these dory bars, which they then send off again. It's a lengthy process, but it requires energy, which mostly comes in the form of diesel fuel and gasoline. When you know what's happened to the price of diesel fuel and gasoline, And so now, I mean, the price of cost of productions went way up, and we're sitting right down on cost of production right now for your ounce of silver. So all you're really paying over the cost of production for the most part is your premium, which is, I don't know what the premiums are right now. I don't think they're real high compared to what you're getting, the value you're getting on an asset that has no counterparty risk. Now I'll explain counterparty risk just for a second, if you guys don't know what I'm talking about. All your other assets that you hold in your portfolio, your stocks, your bonds, everything out there, has what's called counterparty risk associated with it. It means you don't own it. You think you own it. You don't own it. It's the, what's the name of the stock company I'm trying to think of? Is it Seed & Company or whatever? Some big corporation that owns all the stocks, and the banks own all, and the U.S. government is basically owns your treasuries. You don't own these stuff. This all has counterparty risk. You're relying on a second or a third party, so that when you just say, hey, you know what? Just like your money in the bank, the same thing. Your money in the bank's the same thing. You go in there. What if you go in there tomorrow morning and the bank says, no, we're not going to give you your money? That's third party. That's counterparty risk. See? The only way you get away from counterparty risk is like if you got a dollar bill in your pocket, you got it in your hand, your hot little hand, there's no counterparty risk to that. There's nobody can come along and say, hey, you're not going to spend that dollar, or you're not going to have your dollar. Anything that you got that's on paper that says you own this, there's always somebody on the other end who says whether you can have it or not. You have to rely upon them. You have to say to yourself, are they trustworthy? Are they going to give me that money that says I own? Like on your, doesn't matter if it's a retirement account or what it is. That's counterparty risk. And you see, with gold and silver, if you've got the real physical metal, you got no counterparty risk. And you know how important that is, not to have any counterparty risk on your assets? When the push comes to shove, if the banks start to fail, if the system starts to go down, you don't want counterparty risk on anything that you've got. You want to have something real in your hands and your possession. So if these bankruptcies start to go out there, you've got something. You want to eat, see? This is what it really comes down to. So cryptocurrency today. Now, believe it or not, cryptocurrency is an asset class that does not have counterparty risk, provided you get it off the exchange. See, the exchange is your counterparty risk with cryptocurrency, if they're holding it for you. If you've got the private keys yourself, there's no counterparty risk. And so what we're looking at today with cryptocurrency is 958 billion with a Bitcoin price of 20,921. Dow Jones today, down 82 points, down 94 points, at 31,895. So basically, I guess what I'm saying is if the Fed's pulling a head fake on all of us, which I'm starting to think that's what they're doing, then we might be putting in bottoms on almost everything. Real estate, stock market, everything. They don't have the balls that I thought they had. And that they never planned on having a crash to begin with. They were just messing with us. That's what's starting to look like to me. In that case, you know, guys, the dollar is probably not the place you want to be if that's the case. You know, if the Fed's just messing with you and they're just playing like they're going to support the dollar, but ultimately it's all a head fake, so that they can get away with just kicking the can down the road for a few more months and not have the real heavy inflation come so quick, pushing the heavy inflation, the real bad inflation, off into the future a little bit, and keeping the dollar index strong. I think that's what they've been playing at. Okay, Dow Jones Industrial Average is down 94 points. Take a look at oil today, 95.88 today. It's up 1.18%, or $1.25. Now we're going to take a look at the MOVE index, which, as you can see, over the course of the year has been slowly increasing. These shows are coming on. Anyway, bond market today. We're looking at yields falling again. U.S. 10 years fell 7.3 basis points to 2.74, and the U.S. 30 years right at 3%. It's at 2.993. It's down 5.7 basis points. Now we're going to take a look at the dollar index at 107.09. See how strong the dollar is staying? This is, I think, what the real target was. You know, the real target was support for the dollar. This is the reason why we've went through all these years of manipulating the price of gold and silver, is to support the dollar. They've turned a blind eye. They've let these four big bullion banks manipulate the price of gold and silver. They've only ever given them a little slap on the wrist now and again. They've basically turned a blind eye to it because they knew that what they were doing would support the dollar. Because hyperinflation is nothing new. I mean, we're talking about an erosion of the dollar that's been occurring for over 100 years. And the dollar could have slid and fell into the abyss years ago. But they manipulate things to keep the dollar strong, to keep some strength left in the dollar. What, they got two pennies left? That's what our dollar's worth, the same as 2 pennies was back in 1913. So if a guy was going down the street in 1913, he had 2 pennies fall out of his pocket. It was worth the same as our dollar is now, or more. Thank you guys for listening to my show, and now watch for the pets. Bye-bye, guys. Hello, ladies and gentlemen, and welcome to the pets section. We're going to get started right here. We're going to open up the charts right here and take a look at these. I call them charts, but actually, you guys know what I'm talking about. Where is it here? I had it here. That's interesting. Okay, but let me see. I got some pictures here. Here's Sassy. This is a horse, obviously, and very beautiful horse. And looks like maybe she's waiting for a carrot, or maybe an apple, or maybe a sugar cube, you know. Standing at the edge of the gate, you know, waiting for a treat, probably. It's a really nice looking horse. We're going to move on to the next one. Next picture. This rabbit is called Snack, and he's a Netherlands dwarf, I think it is, and got pretty eye color and pretty markings actually with his brown ears, you know, and brown feet, but the rest of him is just pure white, you know. So we're gonna move on. We got another rabbit to show you guys. This is Mary, and I guess it's M-E-R-R-I, or Mary, I think Mary, and she's another dwarf rabbit, and she's all one color though, just a dark chocolate brown, it looks like. So, been a good show. Thank you guys for listening to my show this morning. Appreciate my audience out there. Could use a few more viewers. So if you guys got friends who want to watch my show, like remember, hit the notification icon, hit the subscribe button, you know, and maybe you can get your friends to do the same thing. Really appreciate it, and we'll catch you guys on the next show. Bye bye.